Hello, good morning. My name is Jamal Khan. I'm the head of tax at Churchill Tax Advisors. Today is the 22nd of July and we are presenting our Monday morning weekly tax update. Today we'll cover some of our cases that we have dealt with recently and some of the court cases that have been announced in the last week or so. One of the cases that I wanted to talk about was a Turkish restaurant case that came to us. It was under a Code of Practice 9, fairly serious tax investigation case, the director possibly being prosecuted and being sent to prison. The case had been going on for a couple of years. It was with an advisor in Wales, who was apparently ex-HMRC. The client paid some money to him and the advisor did a runner. Took the money and disappeared. It was quite odd. It was something we don't normally see. So the client was in distress. He was referred to us by their accountant, which is fairly common. We took on the case. The client had a substantial liability as it was a Code of Practice 9 investigation. He was expecting significant figures, and as we concluded the case towards the final meeting with HMRC, we brought it down to roughly about £100,000. This was a significant reduction from the original liability. The client was over the moon, and same goes for HMRC. We are very, very thankful to HMRC for their cooperation and professional behaviour during the course of this investigation, who understood our position, who understood the client's position, and ultimately were able to settle the case without taking it to criminal proceedings and the client being prosecuted. The next case is it's a very odd case because it was announced by the tribunal last week. It's an anonymised case. The appellant didn't want his tax case to be heard in public because of his attention deficit hyperactivity disorder and his depression and his criminal past, which would come out as a result of the public hearing and the case being published. Now, the judge didn't feel that it was appropriate to anonymise the case. Therefore, the judge said that no, we will not allow you to anonymise the case, but you can potentially withdraw your case or proceed with the case as it is. He disallowed the appeal. Now the appellant has got to go back and think about whether they want to withdraw the case, because the judge felt that it's in the best course of public justice that the case should not be anonymised. The next case was a diver, Mr. Green versus HMRC, who received some money from a company. He treated it as a partnership and declared 50% of the partnership income on his tax return, and he said the rest of the income should be his wife's. HMRC investigated. When it went to the tribunal, HMRC effectively, HMRC's point was that this should be employment income. And the appellant said, no, this is a partnership income. HMRC disagreed, went to the tribunal, and in the tribunal, the judge agreed with HMRC's position. There was no specific self-employment contract with the company, and therefore HMRC's argument was upheld. The appellant then subsequently said that no, it should be, if it's not a partnership, then it should be self-employment. And the judge reviewed the contract, the arrangement, and found that the appellant's wife had no involvement. All the work was being done by the appellant, and therefore it should be taxed on him as employment income, which obviously will result in a lot more tax and national insurance, etc., to be paid. The next case is whether retention payment. This is for Murphy versus HMRC, once again announced in the last week or so. Now, in this case, a company had been taken over by another company, PwC. Booz & Company Limited had been taken over by PwC. They wanted to retain the staff so they gave them a bonus of £30,000. Now for Mr. Murphy, he spread it over 3 years. HMRC investigated, and HMRC's position was that it should be taxed in the first year of receipt. Mr. Murphy disagreed, the matter went to the tribunal, and the judge decided that it wasn't a retention to be spread, the retention wasn't to be spread over the next 3-4 years, but retention was given to them on the basis that for them to continue their employment, and therefore taxed in the year of receipt. The result of that was that the tax liability is a lot higher, the national insurance is a lot higher as well, which would have been different if they were allowed to spread the bonus, the retention payment, over a couple of years. The next case is interesting. It's Cambridge University versus HMRC. They had received some donations from endowments from people, and they had a fund manager. The VAT that had been incurred on managing the funds, Cambridge University wanted to claim back that VAT. Now, HMRC, HMRC's position was that they shouldn't be claimed back because it was running an endowment fund or running a fund was not the main activity of Cambridge University. It went to the first year tribunal where HMRC lost and Cambridge University won. It went to the upper tribunal where HMRC lost again, and the Cambridge University won. Then it went to the European Court of Justice. Now, European Court of Justice position was that the collection of donations and endowments is a non-economic activity, and the investment of those donations and endowments is a direct continuation of the non-economic activity. And therefore, it's not a normal day-to-day course of activity for the university. Therefore, the VAT cannot be claimed. This is very important. So if somebody is carrying out any activity which is outside of his normal main activity, and the client tries to claim VAT for the normal course of business, then that could potentially be restricted. So if you are starting a business or a trade which is ancillary to your main business, it's worthwhile considering taking advice, setting a potential new company, or at least adding that to your VAT return, or when you register for VAT, that this is a new activity that we are taking, and therefore we want to be able to claim VAT on it. Very, very important. The next case is Scott versus HMRC, once again announced in the last week or so. This HMRC carried out an unannounced visit for Mr. Scott's VAT return. The idea was that the main issue at hand was that Mr. Scott had been preparing and submitting his VAT returns. He didn't use any accountant, he didn't go to a tax advisor, he didn't use any accountancy software, and as a result, he made significant mistakes in his submissions to HMRC. The issue at hand was whether whether the input tax was correct or the output tax was correct. The issue at hand was whether the penalties that were being charged were deliberate or non-deliberate or careless. And the judges agreed with HMRC's position that the errors that were made by Mr. Scott were so significant, and then he did not make any effort to review or get his position more accurate, and therefore HMRC's argument was upheld that these errors were classed as deliberate. Obviously, the deliberate means that the penalties that are charged by HMRC are significantly higher, can go up to from 50% to maybe 100%, and therefore the tax bill that becomes payable is significantly higher. The next case that we've got is Mr. Clayton versus HMRC. Now, this is another case where HMRC visited a business and carried out a random compliance check. They found that Mr. Clayton's VAT returns had been prepared using the bank statements only, and there were no supporting invoices. Now, Mr. Clayton's claimed that all the supporting invoices had been lost during the office move, and therefore they wanted to rely on the bank statements. But upon examination, HMRC found that Mr. Clayton had claimed VAT on invoices or on expenses which doesn't usually have VAT on it, for example, bank charges, etc. and VAT had been claimed. So that meant that Mr. Clayton had to pay roughly about £95,000 in overclaimed VAT. The matter went to the tribunal, where the appellant, Mr. Clayton, said that I should be allowed VAT, but the judge decided in HMRC's favour. Now, this is quite important for businesses, because a lot of businesses do not keep records, and when they do get a visit, they get something like this. For example, we've got £95,000 of VAT plus penalties. That could be maybe careless, say up to 20, 25, 30% of penalties, or could be deliberate, say maybe up to 100% of penalties. So this is small mistakes. As you continue to make mistakes on a weekly basis, on a daily basis, you might not seem a big amount, but after 4 or 5 years when HMRC do visit, this could potentially be a very, very significant amount and potentially could collapse a business. We deal with cases where people have come to us and they are unable to pay significant debts to HMRC, because these could be, for example, £1,000 a quarter, £5,000 a quarter. Over 6 years, they could turn out to be, say, maybe 150, maybe £200,000, plus penalties, plus interest. So we always advise our clients and the public to maintain full records and to make sure that they are fully compliant. If you have any questions on any of these cases, or if you would like to discuss anything with myself or one of my team, our team of tax investigators or tax advisors, please call us on 0207 998 1834. And if you like our videos, please do the thumbs up. Thank you very much.